We're into the third quarter of earnings season over in the US market, and some positive earnings results has provided a boost to global shares. Both US and European markets were both higher over the past 24 hours. Citigroup announced results that were higher than market expectations. Of course, they are owned 12% by the American taxpayer. Some further acquisitions over in Europe have also provided a boost to global share markets. The US dollar was slightly back in favour over the past day, and after hitting parity, the Australian dollar has tracked back to 98.5 cents against the US. The Kiwi dollar is currently trading at 75.75 against the US and 47.60 against the Great British Pound on Tuesday morning. Back here on the local economic front, the Consumer Price Index was announced on Monday morning. This showed that underlying inflationary pressures remain fairly soft, at 1.5% on an annual basis. In context, this was slightly weaker than ASB forecasts, but it was slightly stronger than both the Reserve Bank and market expectations. On this basis, this is at a very low level and is at the lowest annual rate since 2004. It remains right within the Reserve Bank's target range of between 1% and 3% for inflation. So what does this mean for interest rates? We continue to see that the Reserve Bank of New Zealand will keep the official cash rate on hold through to about March or April of 2011. In terms of term interest rates, they remain very low and have barely moved over the past week. They remain at their very low levels on a historic basis. The international market for lamb continues to look very, very strong. The euro has been strengthening against most currencies, including the Great British Pound, and this is meaning that more UK producers are sending lamb across the shores into the EU continent. When the euro did strengthen last year, exports from the UK increased about 12% from average levels. This is keeping the UK market very tight, and retail prices are increasing. Reports suggest that UK prices are currently around 50% higher than they were at this time last year. This should be good news for farmers back here in New Zealand, but schedule prices have been little changed over the past week. With the New Zealand dollar remaining strong against the pound and sitting between 47 and 48 against the pound for the time being, this is going to limit returns back to New Zealand farmers. We continue to expect to see average schedules in the season ahead to be at or slightly higher than last year levels.